And right now, let's talk to Steve Sosnick. He is Interactive Brokers Chief Strategist. He's joining us from New Canaan, Connecticut. Steve, I want to start with what we have been seeing in oil prices, right? Because we saw obviously the huge drop. The June contract, the June futures contract is rebounding today. Brent, though, hasn't been doing as well. What are traders sort of making of all of this action?
Well, I mean, this has been chaos on a level that most of us can't really ever relate to. I don't think I've ever seen negative pricing in oil, and I think that shocked a lot of people. I think that sort of brought the market, the broader equity markets, into a bit of reality. And oil is its own ecosystem, and we're still unwinding all the effects of what happened in terms of margin calls and stuff like that over the past few sessions. I think right now, a higher oil price means some sort of return to normality. And I think that's taken as a good sign by the equity markets. We're still far from what I would consider the old normal, where we're still seeing Brent, West Texas, below $20 a barrel. But there was a period there where, on Monday, where, we were trading negative on the deliverable and over 20 on the near month. So there's all kinds of weird stuff going on. And I do think some of it, unfortunately for a lot of retail traders, involved USO. And I think there's stuff that we still have to hear from them, because, I think there's a lot of stress on that contract as well, that ETF as well.
Steve, I was curious, when you talk about the broader economic conditions that are being faced by the Federal Reserve, we see these kinds of things playing out because nobody knows what to do. We haven't been here before. Where are the next stresses do you think that the Fed is going to have to address?
Well, the oil patch certainly is one. I think my contention is that there are going to be stresses in some commodity-linked and potentially volatility-linked ETFs. I think we've kind of gotten through the woods on those. I've never been a fan of those for the individual investor, because I think people do not really realize the nasty little feature of commodity and volatility ETFs is that they have futures or options that need to be rolled, and that's an expense. And over time, they tell you on the front page of the prospectus that they don't meet their benchmarks, but people do it anyway but they're trading vehicles, not investment vehicles. I think one of the other things to keep an eye on, and I've been reading up on this a little bit, I'm far from an expert on the topic. I worry about collateralized loan obligations. The thing that really took us for a loop in 2008, 2009 were CDOs, which, collateralized debt obligations. They sort of reimagined them with leveraged loans, which took advantage of the incredibly easy financial conditions we have. Every new financial innovation has its moment of reckoning. It's not clear to me that CLOs have had their moment of reckoning. I think the Fed is desperately trying to avoid that moment of reckoning, and I think that's a good thing. But that would be one of these little scary corners that can come back and bite us as the economy sort of stumbles through its recovery.
Hey, Steve, Rick Newman. Frackers and drillers are an important part of the U.S. economy. We've heard President Trump just the last couple of days talk about possibly more aid for U.S. energy companies. Do you have a read on how much help they're going to get from the bailout programs that are already in place, and whether that might be enough to forestall the chain of bankruptcies that a lot of people are worried about as they start to default?
It's not something I've really got that much of a great read on. I would trust your read better than mine in terms of the actual policy data. But in terms of being able to forestall the inevitable, that's really what we're trying to do. And it depends how quickly demand will bounce back. People looked at the oil debacle, I'm going to call it, over the past few days, and it was basically they have no place to put the oil. But yet, the production cuts don't seem to still be enough to reflect the lack of demand that we're seeing for commodities and oil. So, fracking and to our Canadian friends, oil sands are an expensive way to get oil. And so if you're talking about something that effectively is not economic given market prices, I worry that we're throwing good money after bad. From an economic point of view. And so it becomes a big problem, because, what do you do? Are you just trying to put your finger in the dike with the ocean rushing in? It's hard to say.
Steve, speaking of not knowing what to do, I want to take it on over to earnings because a lot of companies obviously are saying they don't know what to do in terms of offering guidance. Netflix was a big report, the subscriber growth coming in way ahead of estimates. The stock is down today, however, by about 2% the last time I checked. What's your read on how people were setting up for Netflix and have been setting up in general at such an uncertain time for earnings?
Well, I mean, to me, earnings at this point are a crapshoot, and Netflix should have been one of the better bets. And they're set up perfectly for this environment, and their numbers actually told you they were. The problem is it was already trading at an all-time high. Where are you going to go from that? So there was so much priced in. I would be very leery almost of any company on earnings because you have no idea what they're going to say and what guidance they're going to give. I'd actually be, in a sense, more leery of the stuff that people have been buying as sort of the stay-at-home trade. When we've got, let's hear what Amazon's got to say in the next few days. That to me is going to be probably the biggest tell of them all, because in terms of a beneficiary of staying at home, they're probably second only to Netflix or ahead of Netflix. But their retail business has never been all that profitable to begin with. So are they making a ton of sales and not making money? There's so many variables that we have to go on. And the other problem is, the indices, particularly the NDX index, is very top heavy with a lot of the companies that have been beneficiaries of this, which is why NASDAQ is near highs. You're looking at 50% of the index with companies, nearly 50% with Amazon, Microsoft, Apple, et cetera, Google. And you've got some top heavy indices with companies that people have been very bullish, relatively bullish about. And so that creates a risk environment and it becomes very tough to play.
Yeah, setting ourselves up for disappointment, perhaps. We'll see.
Yeah.
Steve, it's always good to see you. Be well. Steve Sosnick is Interactive Brokers Chief Strategist.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.